All right, I know everybody's anxious about the exam, and I promise that we'll spend some time talking about it. I found out a long time ago, if I talk about the exam first and then do the slides second, nobody pays attention to the presentation. At least this way, you'll pay attention to like 5–10% of what I'm going to present. All right, so we're going to be talking about the Code of Professional Conduct, which is very, very relevant to ethical approaches and principles that auditors have to follow. It's generally could be generally applied to accountants as a whole. But the rules that we're going to talk about specifically are going to relate to audit and assurance engagements. So when we talk about ethics and professionalism and all those concepts, these are things that you've heard about many, many times before. I don't think I'm going to be teaching you anything that's brand new conceptually. But if you need a primer on ethics or judgment, then go back to the professional judgment framework that we discussed in week 5. That's a really good idea if you just need context for this. So let's go ahead and I'm going to start out talking about the rules of conduct that auditors and insurance professionals have to follow in the conduct of an engagement. These are very straightforward and very basic. I think I could probably present a lot more detail and it would be completely irrelevant. So when I say that these are self-explanatory, it's not important that you remember what these are. It's more that you understand what they are, and even that's not particularly difficult. So there are a few things that I want to discuss that are kind of relevant in that regard, but I wouldn't worry too much about the details on this. So with one notable exception, doesn't follow heavily. The CPA exam doesn't focus heavily on rules of conduct. We're going to talk about that exception at length. Independence will be the focus of this particular discussion. So I don't think it's useful to memorize the rules, but I do think you should be able to understand and define them, which based on their title should be pretty straightforward. So integrity and objectivity. What does that mean? It means be honest and impartial. If I were to say, what does it mean to be to have integrity and be objective? These are probably the words you should go to. Independence, you know it's important because it has 3 exclamation points next to it. Okay, that's how you know it's important. That's my critical. So no material or indirect interest in the clients, which we're going to refer back to when we start talking about independence. This is by far the most important topic we're going to cover today, with maybe the exception of the exam. I do think that this is something that gets understated, even though the CPA exam has a very heavy emphasis on this, and as AICPA really, really focuses on this in a lot of detail. So independence rules, very, very well pronounced, very, very broad. It's important to understand that we have to follow those. With respect to general standards of conduct, there's 4 general rules: professional confidence, due professional care, planning and supervision, and sufficient relevant data. Basically, this means in assurance and audit engagements, you have to maintain all of these general standards in order for the engagement to be viewed as to being conducted in accordance with the criteria set forth by the Code of Professional Conduct. And these are pretty straightforward. I don't think anything of these are particularly surprising. You do need to be competent. You do need to exercise strong care in your work. You need to adequately plan and have supervision over the work that people are doing. And at the end of the engagement, you need to have the information that's necessary to be able to come to a proper conclusion. So next, our compliance with standards. This is just following general accepted auditing standards. So we follow GAAP. Accounting principles for public company audits, this is going to be follow GAAP. Okay, so follow GAS, follow GAAP. It's important to note that for accounting principles for non-public engagements, this could be any specified reporting framework. But as a very general guideline, we're going to assume that most of our engagements are going to be on generally accepted accounting principles, because that's what you all have been learning this entire time in college. And so that's going to be our criteria, our general rule in this area. So when I say accounting principles, you can think generally accepted accounting principles. That may change depending on the context of the engagement. All right. Acts discreditable. Be good. Okay. Don't do bad things. All right. Contingent fees. Nope. Can't have those. Basically, you can't have an engagement where you basically say, all right, if you get the outcome you want, then that's what I'll charge you. But if you don't get the outcome you want, then it's for free. You have to charge regardless of the outcome of the engagement. All right. Commission or referral fees. No, can't do those either. Okay. Advertising and solicitation. Interestingly, you're probably thinking no, but no, it's actually okay. As long as it's not misleading, as long as you don't provide context for information to say that we can provide services that you actually can't provide. Advertising and solicitation is a little bit of a sore point for me, as I don't really see the need for that with respect to accounting and public accounting specifically. Does anybody watch golf here at a fairly regular basis? They've got people wearing accounting firms on their hats. The most famous one was Phil Mickelson, wore a KPMG hat for the longest time. You know when that contract started? His contract started, I think it ended last year, so he did it for like 15 years. But a contract started back in 2008. You know what else happened in 2008? The global financial crisis, okay? A lot of public accountants were laid off at KPMG while Phil was being paid $6 million a year to wear a hat, okay? So yeah, I'm a little bit bitter about that, a little bit bitter. That being said, advertising solicitation, these are fine context. We just have to be very specific that we know what the rules are, that you can't tell them that you can do things that you can't. Confidential client information, it's confidential, obviously, okay? So make sure you do your necessary duties to protect confidentiality of the information. It can't be disclosed to external parties, except under certain circumstances, which we'll talk about those in just a second. And finally, form of organization and name. Don't say you're allowed to perform CPA services that you aren't. Generally speaking, when we talk about form of organization and name, there are some very specific criteria. You may notice that here in Kirksville, that if you look at some of the local CPA firms, they have CPA firm in there, or CPA in their title. Like they may say Michael Barnes CPA. I'm not a CPA firm, but if I was in Kirksville, that's how I'd solicit myself. But companies like Deloitte and companies like KPMG, they don't say KPMG CPA, they don't say Deloitte CPA. And that actually has to do with this particular rule right here, is that in order to actually fulfill that requirement of CPA firm, you actually have to have every single partner, everybody who's an ownership interest in the organization has to meet that criteria. So if there's a single partner and that partner's a CPA, go wild. Okay, Michael Barnes CPA firm, congratulations. If it's a big firm where there's a lot of partners who are not CPAs, it can't be titled a CPA firm. It still can be viewed as a public accounting firm, but we can't use that terminology in the organization's name. All right, so that was not a lot to absorb in a short amount of slides, but that's basically the overview. The important part comes in talking about some specific rules with respect to these. So there are a few things that I want to talk about. Most of these are fairly intuitive and fairly knowledge or sensible to follow. But let's talk about some notes on individual rules. So contingent fees are generally not allowed. Remember, that was the cat saying nope, 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 still nope. Okay, that was generally not allowed, but they can be used in the case of CPA representation, in legal proceedings, or compilations for third parties. So two criteria can be met. So if there's a legal engagement where the CPA is engaged to actually report on behalf of whether the prosecutor or defendant, then we can use contingent fees based on the outcome. They basically evaluate whether or not the outcome of the case, but whether the evaluation of what the CPA is providing is correct or not. And compilations for third parties, contingent fees can actually be used in that situation. Say a bank wants to actually have a CPA firm perform an audit for a client, or audit for one of their clients in order for the client to obtain a loan. It could be conditional on whether or not their satisfactory performance of that particular audit. So contingent fees, very generally, we're going to say no, that's not something we can do. We can't actually perform an audit or assurance engagement and say pending the results of the engagement, but there are a couple of minor exceptions, commissions and referral fees. So these are generally not allowed as well. There are some exceptions to that are very intuitive exceptions. So they're generally permissible for tax and non-ATS service. The reason this comes up is because the SEC and many regulatory organizations do not allow auditing and assurance providers to provide certain services because it might impair independence. To that end, say that you're an auditor and your client comes up to you and says, you've done a great job. We'd like to hire you for more work. You'd say, I can't do any more work. However, I can refer you to another accounting firm that I think would be able to do a very good job in this regards, and they wouldn't be violating independence. That would be a situation where you, as the auditor, could actually refer another client and they could pay you a commission or a referral fee for that work, simply because you would otherwise take that work. You're just not capable of doing it. So in that regard, there is a rule that allows that. Action is creditable. All I can tell you here is this is the one that talks about conduct. You'd think that there'd be a lot of references to like crime or nefarious actions by a CPA. Interestingly enough, the ones the AICPA seems to talk about the most, it's the weirdest one. Every single question I've ever seen on Acts Discreditable has to do with this particular issue. The failure to return client records following a client demand to do so is apparently a big no-no. If the client says, hey, you've got some of our documents that you used for your audit, can you please return those? And then you don't, that considers to be a major violation of Acts Discreditable. Now, I don't have an explanation for this. Obviously, there's a reason why it's a big deal. I mean, if the client wants their records back, then you should give their records back to them, okay? I don't know why this particular issue seems to be the big one over every single other issue that's been addressed. But this is the one that you'll encounter most frequently with this particular rule of conduct, is the acts discreditable rule about failure to return client records. So it's an important one to note. So I just figured I'd go ahead and let you know about that one. There's also a big list of professional threats and safeguards, part of the conceptual framework for independence. They're relatively self-explanatory. In other words, I'm not going to test you on those. So I probably won't test you on individual rules, except maybe at a very high level. What I might test you on is the next part of the content. So I told you there was some important stuff about independence we're going to cover up. So here's our section, important stuff about independence. All right. So the independence rule is a member in public practice shall be independent in the performance of professional services. All right. This applies to all forms of attestation services. And we talked about different types of attestation services that can be provided. So this is going to be engagements, or sorry, examinations, reviews, and agreed upon procedures, as well as audits, because audit is a form of attestation service. And covered members, sorry, it's going to be required to apply. I'll get to that next statement here in a second. It's also going to be applied to certain aspects of assurance services. Specifically, reviews are required to have independence. Okay, and independence is considered, though not required, for compilations. Remember, we talked about compilations. You don't have to be independent, but you have to disclose if you're not independent. So what is the general guideline for independence? And that has to do with this term called covered members, okay? These are going to be our criteria for determining if somebody's independent, all right? Or somebody needs to be independent, I should say. So this is our first question. What is a covered member? And there's a big, long list. And you may say, this is unfair, Dr. Barnes. Do I need to know this list? The answer is, are you going to be an accountant? Okay. If the answer to those questions, the answer to the second question is yes, then the answer to the first question is also yes, all right? So who's a covered member? Easy one is somebody who's on the engagement team. If you're on the assurance engagement team and you're required to be independent, you are a covered member, all right? An individual in position to influence the attest engagement. So this is somebody who's not necessarily working on the engagement, but could have some sort of influence or have some sort of act in. So this is a partner who might be very close to the engagement team, though not necessarily on the engagement team. Any partner who provides more than 10 hours of non-attest services to the attest client within the fiscal year. So this is going to be very rare for public clients, but this can be common for non-public clients. We could have a different partner who does not perform attestation services, but if they perform 10 hours of non-attest services on a client that already receives other attest services. So say, for example, one of the partners in another part of the firm provides tax planning services. They're not on the attestation engagement, but if they provide 10 or more hours of service, they are still required to be independent. A partner is in the office in which the lead attest engagement partner primarily practices in connection with the attest engagement. So we talked about an organization here in Kansas City. Say we're talking about the Reuben Brown office in Kansas City. The partners who are in the Reuben Brown office in Kansas City have to be independent of all engagements that take place in Kansas City. That's not true for like Reuben Brown in St. Louis. St. Louis would be a different office, and not all partners would have to be independent of the Kansas City offices, but they have to be independent, or Kansas City clients, but they'd have to be independent for all the St. Louis clients. The firm itself, which includes the employee benefit plan, this is actually pretty interesting because this actually limits the amount of external investing you can do as an accountant in a firm like that, because the firm itself has to be independent. This makes some very interesting scenarios when you actually start signing up for your benefit plans as an accountant. Most big firms, they actually have large investment brokers that handle these engagements for them so that they can get portfolios that are not violating independence. But if you decided you want to do a 401k as an accountant and you say, I'm just going to invest in a mutual fund, you may not be able to do a full mutual fund because your employer benefit plan may restrict the amount of investing that you could have associated with a really large client that's in that fund. So that's something that you'll have to be very cautious about, particularly if you handle your own investments. You have to be independent in that regard. And any entity whose operating financial accounting policies can be controlled by any of the individuals or entities described above, okay? So that's just a general guideline. If there's any control that can be exerted by somebody else or can be controlled by any of the individuals listed above, then they have to be independent as well. So these are all directly covered members, which that's a long list of things to remember, a long list of details to remember. But it gets worse, okay? Because there are also individuals who are not covered members, but still have to follow the rules of covered members, all right? We're going to talk about those in just a second, but let's talk about what we mean by independence, okay? So prohibited financial interests are going to be direct financial interest, which is very, very obvious. Stock ownership in a client, which includes partnerships of trust. This can also represent large credit ownerships in a client, although that's not considered to be the same level of ownership, but if it's considered to be significant enough, then it would be considered that. So material indirect interest. So these are not going to be stock or debt ownership in a client, but these would be large enough if even though they're indirect ownership, and if they're material, they would still be considered violations. So this would be stock ownership of a client subsidiary. So you don't own the client itself, but a client subsidiary, you do own stock in that. It's only going to be a violation of independence if it's a material amount. Now, what does material amount mean? That's subjective, okay? You would have to justify that your ownership is not a material interest. Usually, when you start getting into percentages that can be measurable, that's when you start getting to material amounts. Like if you say, well, I only have a 5% interest, that would definitely be material interest. So usually there's not a bright line criteria, but it's obvious in most situations. If you have a mutual fund investment in a client, again, this may restrict your ability to invest in mutual funds or index funds types in an organization. If the client representation within that fund is large enough that it would be material interest. So, if you have a mutual fund, it's only a few clients, and a large proportion of that is a client that you're currently auditing, and your investment would represent a material amount of wealth, with respect to the amount of your investment. Then you would have to say, okay, I'm not independent. I have to divest that particular item that's in my portfolio. Then finally, the financial interest of close family members. So you could not have any financial interest at all. You could have no investments at all. But if you have close family members, say like a spouse or a dependent who actually has a material interest in the client, they could be violating that rule for you. So you have to be very careful about that. Now, there's an important note that certain bank loans are okay. Usually these bank loans are going to be below a certain threshold, usually $10,000, or they're going to have have been ones that existed for a period of time before the engagement started. So say, for example, that you got a mortgage through US Bank. That's where my mortgage is through. And then a few years later, you start auditing US Bank. Depending on the length of time, usually I think it's at least 2 years, but it could be longer. Depending on the length of time, you could grandfather that loan in and still be independent because you had a pre-existing loan with them. Another scenario that might come up, and this is just something that might, just for references, credit cards with balances less than $10,000 are generally considered okay. So if you're doing an audit of a financial institution, if you've got a credit card with them, as long as that balance is going to be less than $10,000, then you're fine on that, okay? So it's a good guideline. So independence is impaired if the CPA performs managerial or other significant activities for the organizations during the time period covered by an attest engagement. Now that's a pretty obvious statement, all right? Say, for example, that you decide to help them set up an accounting information system for reporting, and then you audit on that same accounting information system. You're effectively auditing your own work, which that's a pretty big, obvious conflict of interest in that regard. So all this statement is saying is that if you provide some service that you're eventually going to be evaluating or provide assessment or assurance over, then that's a violation. That's a violation of that independence rule. Interestingly, relationships and trade associations, which are country clubs or are honorary trustees of the client, like charities, are not considered to impair independence. So this scenario comes up if you're in the same country club as a client. Generally, that's not considered to be a violation because that's just a passing relationship. And then if you're doing performing an audit for a charity, for example. Can you actually be on the board of directors for that charity? No. Okay, that would be a violation of interest. But if you were an honorary trustee, somebody who does not have a working position where you make decisions for the organization, that would be something that would be acceptable. Okay, so usually the definition of honorary trustee means you can't have any financial implications or decision-making positions within that company. All right. As far as family relationships goes, this is what I was talking about. Certain individuals will still have to follow those covered member rules. So covered members are talking about that big list we looked at. In addition to those, these are people who have to follow the covered member rules. Who are those people? All immediate family members of the client or of the covered member. Okay, they are subject to the same independence requirements. That's going to be your spouse or your partner, and any dependents. Now, dependents is a very divisive statement because usually we tend to think of children as dependents, but you can have non-dependent children that would not violate this rule. And you could have somebody who's living with you that's a family member that is still a dependent, though not a child. Like this often frequently happens when you got parents that are being taken care of in some regard. They can be viewed as a dependent. Effectively, if they're viewed as a dependent for tax purposes, they're going to be viewed as a dependent for this rule as well. All right. In addition, independence may be impaired for covered members with close relatives. Now, who are close relatives? These are going to be parents, okay, siblings, and non-dependent children. Okay, so anybody who's not a dependent, that's still kind of within arm's width or arm's length. So parents, your brothers or sisters, or any of your children that are no longer living in the house and no longer dependent on finances for you. Those would be people who are close relatives. If they have material financial interest in the client, so if they have invested in the client and it's a significant amount of their portfolio, they could violate that rule for you. So they would need to be covered member or follow the covered member rules as well. Or they have significant influence over the client. Say, for example, you've got an audit client and your mother is the CFO. You'd say, all right, this is probably a violation. This is probably a violation of that rule. So again, the rules for this particular guideline are not that these individuals are covered members, but they still have to follow the rules of covered members, okay? They have to still follow the same independence rules, which is really, really annoying because now not only do you have to be responsible for what you're doing, but you have to be responsible for what your family members is doing or are doing as well. So immediate family members, close relatives. It's generally a pretty close guideline. Interestingly enough, uncles and aunts are not considered to be close relatives, which really, really annoys me, okay? Because, yeah, I consider myself to be quite a great uncle, but yeah, I'm not a close family member. Who knew? Yeah, anyway. All right, last thing we'll talk about. So some other factors that can impair independence, some interesting things. So past due engagement fees that are greater than a year. All right. Basically, this is a guideline where we're saying that if you've got outstanding fees that are due by the client and they have not paid and they're over a year old, that represents an ownership interest. And I think we talked a little bit about that already earlier this semester, but the logic behind this is that if you've got a payable that's over a year old, that's a long-term payable. Long-term payables have implicit interest regardless of whether there's actual interest on those. So if there's implicit interest, it represents an ownership interest. You can't audit or provide attestation services for anything that you own, okay? Also, actual threat of litigation. If litigation is commenced or it's probable litigation will commence, the client against the CPA, independence is considered impaired. So what that means is that if your client says, you know what, we thought you did a terrible job this past year, we are going to sue you for every dollar you're worth. See you next year for the audit, okay? That's not going to happen, okay? That's not going to happen. If the litigation has commenced, if it started, or if you think that it's likely that litigation will occur with the client, you have to cease all attestation activities with that client because you can't remain independent in that regard. Usually independent in much opposite direction. Your bias is probably going to be against the client as opposed to for the client. Even so, it's considered to be an independence violation. And with that, that's the end of this discussion. So hopefully you got a little bit out of that. Like I said, there's probably not a lot that we're going to be talking about on the third exam for this, but there will be at least one question on this. Yes.
So as far as like the family member thing and determining like what's on the serial account, as far as you know, would most public accounting firms, would they be able to like help you in deciding that, or is it entirely up to you?
It's very subjective. They will provide you guidance, but in the situations that comes up is they will more often than not say, if you have any concerns about it, if you believe that it might be a material amount, that it's usually better to opt out of it than to move forward with it. Better safe than sorry is kind of the general guideline that the firms will go with. Some of the interesting things about this is that accounting firms, especially the large ones, are very, very sensitive to this. So they will send you out disclosures and make sure you have independent surveys every single period with respect to your clients, and they will monitor your activity. It's only if you do independent investing, those are the things that can kind of get you in trouble because they won't have any the firm supervised investing activities like 401ks or things along those lines that will violate those rules. So, all right.